Picture 1969. The North Sea. A drill ship hitting oil. Enough hydrocarbons to reshape a nation. Here's the trap every nation before Norway had fallen into. They saw wealth arriving and asked, spend it now or save it? Every single one chose now. Venezuela had more barrels than anyone. By 2016, its GDP collapsed 75%. Nigeria found oil and watched corruption bloom through every institution. Angola, Ecuador, Russia all took the same path. Find treasure, spend the treasury, watch the currency burn. You probably think you know how this story ends. Norway found oil in the North Sea and became wealthy. But Norway refused to spend the principal. The resource curse is not metaphorical. It's a documented economic pattern that repeats like clockwork. Your nation finds abundant natural resources. Your government gets drunk on the cash flood, tax revenue surges, spending explodes. Then the cycle inverts. Oil prices drop, revenues crater. But government spending doesn't drop, because your budget is now structurally dependent on commodity prices. Inflation spikes, currency weakens, foreign investors flee. What you thought was wealth becomes a trap. Venezuela in 1998 was producing 3.2 million barrels per day. By 2025, less than 400,000. The people didn't get wealthier, they got poorer. The government rotted from inside. But is the curse the oil itself? Not quite. It's what humans do when oil arrives faster than institutions absorb it. Norway in 1969 was not a special nation, blessed with superior leaders or genetics. It was a small Scandinavian country with 4 million people and decent governance. What made Norway different was a decision made before the oil arrived. In 1990, 21 years after the discovery, Norway's parliament created a sovereign wealth fund called the Petroleum Fund, later renamed the Government Pension Fund Global. The first deposit happened in 1996, and here's the paradox. Norway didn't spend the oil money. Instead, it invested the oil money. It treated the windfall like an inheritance. Invest the house, so it generates rent forever. That distinction separated Norway from every nation before it. How does one rule change the entire outcome? By 2025, the Government Pension Fund Global held $1.9 trillion, 340,000 per Norwegian citizen, making it the world's largest sovereign wealth fund. They didn't spend it recklessly. The fund grew because of two mechanisms working together. First, the fiscal rule. The government could spend only 3% of the fund's expected return per year, not 3% of the total fund. If the fund was expected to grow 3% annually, the government spent roughly the growth and left the principal untouched. When you protect the principal, it compounds. The second mechanism was global diversification. Norway could have invested only in oil companies, pump and pray. Instead, the fund spread itself across thousands of companies in multiple asset classes, equities, fixed income, real estate, across 70 countries. When oil prices crashed, the fund wouldn't collapse, it would hiccup. Your pension depends on this math, not because you live in Norway, but because if Norway had failed, every resource-rich nation would have been doomed. But Norway didn't fail. The fund moved through booms and busts without panic spending, because discipline held when pressure peaked. The third mechanism gets less attention than it deserves: transparency. The Norwegian fund publishes complete holdings, every investment, every vote, every loss. You can look it up yourself. Venezuela's oil fund? Hidden from citizens. Nigeria's oil revenues? Opaque. Russia's sovereign wealth? Shrouded. But Norway's fund? Open book. It scored a perfect 100 in the Sovereign Wealth Fund Transparency benchmark. Transparency prevents the political capture that destroyed every other oil nation. When the fund is hidden, politicians raid it in the dark. When the fund is public, politicians can't explain why they're spending principal on elections. Transparency forced discipline. The Norwegian ministry publishes quarterly reports that parliament debates and media scrutinizes. What does that accountability protect? From 1996 to 2025, across 29 years of oil booms and crashes, not once did Norway abandon the 3% rule. Not in 2008 when banks were collapsing, not in the pandemic when governments were spending wildly, not during the 2022 energy shock when oil prices spiked. The rule stayed. Spend only 3% of anticipated returns. This sounds simple until you're living it. Imagine you inherit a house worth $1 million, throwing off $50,000 in rent annually. The rule allows you $30,000 a year. You have a deficit. Schools need funding. Every politician screams, use the principle. Yet you say no. In 2020 and 2021, during the pandemic, Norway's government exceeded the 3% rule because the emergency was real. Then what happened? The government came back into compliance. It wasn't a suggestion that erodes under pressure. It was written into law. Here's what most people miss. The money had to go somewhere. The Norwegian government didn't ban spending. It created a pipeline. Oil revenue flows into the fund. The fund invests globally. Fund returns flow out at 3% annually into the budget. The budget funds schools, hospitals, defence, roads, pensions. The government didn't become poorer by saving the principal. It became richer because the principal compounded. A fund that grows 5% per year but pays out 3% grows 2% in real terms. Over 29 years, that compounding multiplies exponentially. The government in 2025 gets far more funding than it did in 1996, even though the draw rate stayed the same. In Venezuela, oil revenue spiked during booms and vanished during busts. In Nigeria, oil corruption meant some revenue never reached the budget. In Norway, the pipeline smoothed the income flow, turning volatility into budget stability. By mid-2025, the Norwegian fund owned pieces of almost 10,000 companies globally. It was not a fossil fuel trust, despite holding some energy stakes. The equity portfolio spanned 70 countries. When you own 1.5% of all listed companies on Earth, you don't get rich betting on one sector, you get rich betting on the world. The fund voted as a shareholder on climate issues, worker rights, executive compensation, not because Norway is sanctimonious, but because a fund that size can't hide from scrutiny. This meant thinking about long-term value instead of quarterly earnings. A company extracting short-term value, but polluting long-term, looks attractive one quarter and becomes liabilities next. The fund had to ask, what will this company be worth in 20 years? That thinking changes how you allocate capital. It's the opposite of the curse. Here's the tension. Can other nations replicate what Norway did? The answer is frustratingly precise. The fund structure itself is copyable. Mauritius created a sovereign wealth fund. Botswana created one. Timor-Leste created one. All copied the architecture, but they didn't copy the result. Why not? The architecture alone is only 30% of the solution. The other 70% is institutional discipline and governance. You need a parliament that respects its own laws. You need a central bank that doesn't get overruled by political pressure. You need a civil service that can't be fired for saying no. You need media that can report without threats. Venezuela had laws that were ignored. Nigeria has laws that are bent. Russia has laws enforced only when convenient. Norway's laws hold because the entire society agrees they should, but there's pressure building in real time. In 2024 and 2025, some Norwegian politicians began questioning whether the 3% rule was too strict. Spending pressures are rising as aging populations need healthcare and climate transitions demand investment. Some officials have suggested moving to a 4% rule or indexing withdrawal to needs instead of returns. If this happens, a 4% rule isn't the resource curse, but it's a reminder that rules written into law are subject to erosion if political will shifts. The rule survived 2008, 2020, 2022, but the pressure mounts. The fund could theoretically fund the 3% rule indefinitely, but if the rule itself gets rewritten during the next political cycle, the entire mechanism collapses. That's the risk nobody talks about. Not that the fund will run out of money, but that politicians will run out of patience. Because here's what most people don't understand. During oil booms, the fund grew faster than the 3% rule allowed. In 2021 and 2022, with oil prices high, the fund was generating returns that could support higher spending while still growing principal. That's exactly when the curse attacks hardest. That's when politicians say, the fund is big enough, let's spend more. But Norway didn't yield. It stuck to 3%. Not out of religious devotion, but out of institutional memory. They knew what happened in other countries. They studied the pattern. They decided in advance that when temptation came, they wouldn't surrender. It's like making a deal with yourself when you're rational, so that when emotions are high, you can't break it. That's what a written rule is, a commitment to your future self made when you're thinking clearly. Venezuela didn't make that commitment and spent when it should have saved. What Norway did matters beyond Norway, because the fund holds 1.5% of global stock market value. Norwegian decisions about which companies to fund, which industries to avoid, ripple across thousands of firms. When the fund divested from Israel or announced climate policies, global markets shifted. Small choices at a sovereign wealth fund level become material signals across continents. Singapore, Saudi Arabia, Abu Dhabi all studied Norway's model. Not to copy it exactly, but to understand why it worked. And that changed how some sovereign wealth funds operate, with more transparency and long-term thinking. The resource curse still exists in Angola and Equatorial Guinea, but the conversation changed. Instead of, what do you do with oil money? The question became, how do you avoid the trap? But let's be honest about what Norway hasn't solved. The generational question. The fund was created in 1990 to provide pensions for future Norwegians. Today that mission is under pressure from forces beyond political control. The fund can probably support Norwegian pensions indefinitely if the 3% rule holds. But climate change, energy transitions, demographic aging could compress returns or expand needs. Some analysts argue the fund won't sustain current pension promises if you run the math forward 50 years with honest assumptions. This isn't a crisis yet. It's a mathematical tension that will become political pressure by 2050. Norway's children might inherit a smaller fund than their parents hoped, not because of bad policy, but because the world changed. The real lesson isn't Norway solved the problem forever. It's Norway delayed the problem by making the right choice. Venezuela's oil reserves are larger than Norway's. Nigeria has vast reserves. Iraq has vast reserves beyond measure. But none created a mechanism to insulate government budgets from commodity chaos. So when oil prices fell, they fell into the curse spiral. Lower revenue led to higher spending pressure, led to inflation, led to currency collapse, led to brain drain. The difference wasn't the oil itself, but the rule. The mechanism that separated oil from the budget. Not abundance that destroys, but discipline that protects. Not oil wealth as curse, but fiscal discipline as cure. Norway took the same resource that destroyed Venezuela and Nigeria, and because of a rule passed in 1990, the same resource produced stability instead of collapse. The mechanism is transparent, repeatable, teachable, but it requires something every nation has access to, and almost none implement. The willingness to say no to yourself in the present, to protect your future. Back in 1969, when the drill ship hit oil in the North Sea, Norway had a choice, like every nation before it. Most nations had made that choice and were bankrupt by 2025. But Norway chose differently. Not because Norwegians were smarter, but because in 1990, Norway's government decided to create a rule. Treat this like an inheritance, not a lottery ticket. Invest the principal, spend only returns, keep it transparent. 29 years later, the rule held. The fund grew to $1.9 trillion. Every Norwegian citizen got richer, even though the government didn't spend wildly. The fund, in theory, could fund that balance for generations if the rule never bends. But back in that North Sea oil field, the real trap is being installed right now. Political pressure is building. The rule is being questioned. The inheritance is still sitting there, waiting to see whether the rule survives long enough for the next generation to inherit it intact.